Kia ora, and welcome to the CoreLogic Property Market Update for August 2019. A few surprises sprung this month. July sales figures were stronger than expected, and we got further confirmation of investors being a strong part of that lift. But of course, the biggest surprise was the Reserve Bank's official cash rate decision at the start of August. They cut from 1.5 to 1% flat, and it caught everyone on the hop. So if the bank was going for shock value, they certainly got it. Whether they get the intended stimulation to the economy from it remains to be seen. But from a property perspective, we're most interested in the flow on through to mortgage interest rates. Floating rates did immediately drop, but we must remember only a small percentage of mortgages are on floating terms. So it's the impact on fixed rates we're most interested in when it comes to the property market. And the net result was not much. This was partly due to most of the drop in the OCR already being priced into the bank's mortgage interest rates, as many were expecting the OCR to fall to 1% later in the year anyway. But we also need to remember the likelihood of the increased capital requirements for the banks next year. In other words, they'll have to hold more cash reserves. This will cost them money. So to start preparing for that, it makes sense that they'd look to keep fixed mortgage rates the same even as the OCR dropped. Or in other words, raise the lending margin. The other thing that caught my eye from the Reserve Bank was the reporting of debt to income statistics now. Does this mean they could impose restrictions on DTI ratios in the future? Maybe, but as it stands they don't have the mandate to. And in general, the stats show an improving situation, with fewer people today borrowing more than 5 times their income when compared to 5 years ago. I'd say the bank will be keeping a close eye on this though, as the trend in 2019 has started to lift. Now, back to those sales volumes I mentioned earlier. July was a relatively strong month, and it changed the picture when we analysed the year-on-year comparisons over the last 3 months in our main centres. The drops in Auckland and Tauranga are much smaller than we saw last month, at negative 2% each, and now the other 4 centres are reporting an increase of at least 6%. Even though this is a smooth 3-month view, I think it's a bit early to say things are properly back on the up. But it's clearly a sign indicating things are unlikely to drop much further. If we look at our bioactivity data, we see a lift in multiple property owners, and in particular, those with a total of 2 properties, and to a lesser degree 3 or 4 total properties. We touched on this last month when we looked at Wellington bioactivity, and it seems buyers in the capital led the pack, as this activity has spread to the rest of the country. We're now a few months since the Prime Minister ruled out a more comprehensive capital gains tax, and I think this is one of the factors for this recent lift in multiple property owner activity. A previous uncertainty has been removed, and given the lack of investment options elsewhere, this has meant people more confidently considering property again. So what does all this mean for our sales forecast? Well, it means a lift. We're now expecting over 90,000 sales this year, a few thousand more than we were previously, and over 95,000 next year. Most of this is due to the lower OCR and also relies on our economy to remain firm, which not all economists agree with. So I would perhaps treat it with a little bit of caution if you too are a bit sceptical of the general economic outlook. We will be keeping that sales forecast up to date for any more surprises, so make sure you regularly pop along to CoreLogic.co.nz to keep on top of it all. Most imminent is the release of our pain and gain report for Q2 2019. Spoiler alert, the pain is still relatively low, although the Auckland apartment data provides a point of interest, potentially reflecting a consequence of the foreign buyer ban. Mā te wā.